Insurers know better than anybody. You've got to look down the road into the future so you know what the risks are, because you're providing insurance not just for tomorrow, but for the next generation. And climate change is upsetting that apple cart every day. We've learned in this last year how climate change maybe impacts public health. We better think differently about public health and health insurance. We know how climate change is impacting tides and rising sea levels, what that could mean in terms of flooding, what that could mean in terms of impact on your home. These are the type of things that insurance has to pay attention to, which is why it's so important you're working on this today.
Hello, everyone. I'm Andrew Mays, and I currently serve as the Insurance Commissioner of the great state of Connecticut. I am extremely proud to welcome you to the C4I, the first Connecticut Conference on Climate Change and Insurance. From a personal perspective, it's good to see how interest in the impact of climate change has evolved over the years and is now approaching the level it deserves to be, because climate change is a foundational issue for all of us on this small planet, and it has the potential to be not just an economic, but an existential threat to so many of us. It is worth noting that it was back in 2005 that Connecticut hosted a conference on climate change called the Connecticut Global Climate Change Summit, Business Risks and Opportunities for Connecticut's Insurance Industry. And under then Governor Jody Rell, Connecticut Insurance Commissioner Susan Cogswell welcomed participants as I welcome you now. And for the record, by the way, that was a Republican governor. A Democratic governor, Dan Malloy, and his insurance commissioner, Tom Leonardi, also hosted a similar conference. I say this to demonstrate how, as a state with the second highest percentage of insured property in the country along its coast, Connecticut has long recognized the importance of climate change and the need to work with our state and federal partners and all stakeholders, many of whom you will hear from over the next 2 days, to address this threat and preserve our futures. Today, we bring together a national audience consisting of all the stakeholders to openly discuss the impact of climate change on insurance and to better understand and explore how climate change affects our communities, our regulatory efforts, and our businesses. We have assembled 5 panels today, each with highly qualified and respected experts in their fields. But before we hear from them, I would like to thank my governor, Ned Lamont, for his continued support on efforts to address and mitigate the damaging effects of climate change. In 2019, Governor Lamont issued Executive Order Number 3, which reestablished and expanded the membership and responsibilities of the Governor's Council on Climate Change, also known as the GC3 for those of us here in Connecticut. In addition to continuing to address mitigation strategies to reduce greenhouse gases, the newly expanded council will address the importance of adaptation and resilience as the climate change evolves. The United Nations released a new alarming report recently calling attention to the increasingly obvious effects of climate change. That report found that climate change is not only widespread, rapid, and intensifying, but that some trends are now irreversible, at least during the present time frame, which is our lifetime and that of our children. AXA just released the 8th edition of its Future Risk Reports today, recently, surveying more than 23,000 people. And in the insurance industry, it may not surprise you to know climate change risks are at the top of the global ranking. And the much anticipated Intergovernmental Panel on Climate Change report, that's a UN report which was agreed to by almost 200 nations, that stated we all must do our part as a world community, as a nation, a state, a business, a family, as individuals to mitigate these effects on our planet and on future generations. Over the 2 days of this conference, we all will get a fresh perspective on climate change and insurance with numerous panels and individual speakers and what I hope will be enlightening discussion. Now, I know I'm excited to learn and to hear different perspectives today and tomorrow. I hope you are too. Thank you for joining us, and welcome to the Connecticut Conference on Climate Change and Insurance.
Hello, everyone. Welcome to the Connecticut Conference on Climate Change and Insurance, panel on asset management. I'm Maryland Insurance Commissioner Kathleen Borain, and I'm very pleased to moderate this panel discussion today. I'd like to thank the Connecticut Insurance Department and Commissioner Andy Mays for hosting this important conference on climate change, and particularly on addressing how climate risk impacts asset management for insurers. This is among the most significant issues facing the insurance industry today. With respect to my own background on this issue, I chair the Solvency Workstream of the NAIC's Climate and Resiliency Task Force and was part of the insurance and reinsurance sector at DLA Piper prior to becoming the Maryland Commissioner in May of 2020. And I can tell you that the issues being addressed by our panel today are top of mind at the C-suite for many insurers, particularly global and national companies, and they are also top of mind for international, federal, and state regulators. Historically, considerations regarding the impact of climate change on insurers has focused on underwriting risks and the liability side of the balance sheet. However, the business risks that insurers face in relation to climate change go beyond underwriting exposure and include the impact of climate on all aspects of the business, including assets. Government regulation and financial market activities in response to climate changes impact asset values and expose insurers to financial risks associated with transitions away from certain carbon-intensive sectors. Over 190 countries signed on to the Paris Agreement in 2015, which set out a global framework for combating climate change. The primary goals of this agreement are to keep the average global temperature rise this century well below 2% average above pre-industrial levels, and to pursue efforts to limit the temperature increase to 1.5 degrees Celsius over recent years. More than 130 countries have announced their ambition to reduce emissions to net zero, and many have set legally binding targets to reduce emissions. The transition away from carbon-intensive industries will impact asset management and investment strategies, and is an increasing area of focus by some insurance and financial sector regulators. And we are very fortunate to have a distinguished group of experts with us today to discuss this issue. So let me introduce to you now Jeff Mohrenweiser, who is a senior director in Fitch Ratings' North American Insurance Rating Group. He leads the insurance-linked securities team and has rated over 50 transactions with total issuance exceeding $30 billion, ranging from catastrophic bonds to reserve financing transactions and value-in-force deals. Jeff also performs actuarial, product, and modeling analysis and successfully led Fitch's development and deployment of PRISM, a global stochastic capital model of insurance companies. He participates in rating committees, develops criteria, and writes industry research. Jeff, do you have some opening remarks for us today?
Thank you, Commissioner Borain. Just as background, just to define who Fitch Ratings is we are a global rating agency. We operate in we have offices in over 30 countries, employing over 1,500 employees, and we've rated over 20,000 entities. And those entities range from corporate securities to structured finance securities, financial institutions, and public finance. So we're a very broad rating agency. Within the insurance sector, we have over 1,300 ratings on companies located throughout the world, North America, South America, Europe, and Asia. So our focus tends to be on the larger insurance companies, those particularly who issue debts. So We have a pretty good diverse range of insurers that we talk to. Over the last 2 years, Fitch has developed what we call our ESG relevance scores. This applies throughout our company, throughout all of our sectors, throughout all of our entities. Climate change is one of the 14 factors that factor into our ESG relevance scores. Our ESG relevance scores are independent of our financial rating or claim paying ratings. Our ESG scores are on a basis of 1 to 5, 1 indicating that we don't think the risk is inherent to the industry or very low to the industry, where a 5 says that it is very important to that particular company or entity. I mentioned this just in context that climate change, in our view, kind of gets swept up into the broader ESG or sustainability goals that you start seeing asset managers talk about. So sometimes it's a little bit difficult when you see a company or an insurer company saying that they're divesting out of a particular company. Is it because they're a coal-producing entity or because they have a bad track record or mistreatment of their employees? So sometimes these ESG issues kind of segue into one category or another. So a few observations that we've seen discussing climate change with our rated entity. We do see large insurers employing similar tactics as other asset managers such as BlackRock and State Street, who have tended to gather the headlines. I don't know if insurance companies are quite seeking the headlines as always, but behind the scenes, some of them are implementing the same game plan. One is just basically identifying the risk. What are the inherent asset risks do I have in my portfolio? 2, what are my risk tolerances surrounding those risks? 3, how do I measure and then report on those risks? And then 4, and the last step is how do I capitalize or mitigate those risks? So it's a moderate, thought out game plan. It's not a knee-jerk reaction that we need to immediately divest out of coal-producing or oil-producing companies. 2, we recognize that the challenges that insurance companies face sometimes tend to be on the regulatory front. As you mentioned earlier, the European Union is a little bit further out with developing their rules and reporting requirements. The SEC is just undertaking, what they want their companies to report. And then obviously we have the challenges of the various NAIC/state regulations. So until we can kind of coalesce all of these things, I think, the insurance companies need to kind of bide their time a little bit. But I think they do have the expertise in this. If you think back several years ago when enterprise risk management and ORSA were the new buzzwords, insurance companies were saying, well, what does that mean? What is it? What am I supposed to do? But I think gradually we've seen improvement in those reporting standards. And I would expect similar advancements once we start getting our hands around climate change. 3, we think that insurance is taking a measured approach. And again, they are systematically pruning their assets. They have to make sure that any mass overhaul of their asset portfolio, they need to find something to replace those assets. And frankly, there just are not enough green bonds or green labeled bonds out there to satisfy that replacement. To protect policyholders, you need to make sure you still have sufficient yield. You still need to have good liquidity. You still need to have good diversification. So again, we think that insurance companies are going to be taking a very prudential type review of their asset portfolio. And then finally, I think, when you start drilling down, you have to take a look at how climate change can then affect the entire asset portfolio. The easy one to pick on, I think, are oil producing or coal producing corporates. But then you also have the challenges if you invest in muni bonds. And what about those municipalities or cities that are close to the ocean, sea level rise, or prone to flooding, as we've seen, especially here with Hurricane Ida? You can even go down further to mortgage loans, real estate, those that are exposed also to flooding, and also those cities close to the border where you have hurricane or earthquake risk. So companies, again, need to take a top-down approach through all their assets, whether it's equities or fixed income or real estate. And I think they will do that and come up with a good game plan. Thank you very much.
No, thank you, Jeff. I mean, you're right. It's comprehensive, it's incremental, and it's, the long view. So let me now introduce David Robinson, who is the Executive Vice President and General Counsel of the Hartford and oversees the Law Department, Government Affairs, and Compliance. He also chairs the company's Environmental Committee. David joined the Hartford in 2006 as a Senior Vice President and Associate General Counsel. He served as Director of the Property and Casualty and Group Benefits Law Group and led the company's Enterprise Transformation Office. Prior to that, David served as Corporate Secretary and the Director of the Corporate Law Group, overseeing all securities, corporate governance, mergers and acquisitions, intellectual property, and commercial law matters. David, thanks for joining us today. Have some opening remarks for us.
Yeah, thank you, Commissioner Bahrain. I hope you can hear me okay. And thanks to Connecticut Commissioner Mays for convening this forum. I'm pleased to have the opportunity to speak on this important topic, and I'll try not to repeat some of Jeff's points, but they support some of the things that I'd like to share. And let me start with a little bit of background regarding the Hartford's journey on climate change, both from an asset and a little bit from a liabilities perspective. And then I'll talk a little bit about what I think that the industry is expecting to see as the regulatory quotient continues to grow on climate. So at the Hartford, we've been on a journey of greater transparency and greater action over the last several years. In particular, we've been listening to and responding to asset managers and other private stakeholders who in many ways have been the leading voices so far in standard setting and accountability when it comes to climate initiatives. The importance and the frequency of reporting on what we're doing has obviously been growing over time. For example, we recently published our first SASB report. We just published our second TCFD disclosure recently. And those are clearly two big pieces in the larger kind of tapestry of voluntary sustainability disclosures that the Hartford's been doing. Of course, we also complete the NAIC's climate disclosure survey annually. I should note that fairly and appropriately disclosing all that we're doing in this space is a bit of a growing challenge. Up until recently, expectations for what to report and how to report were kind of all over the map. We're starting to see some of that coalesce, some preliminary efforts among climate assessment actors to harmonize their asks of companies and coalesce around a set of consistent reporting standards. And we support that progression as a good thing. The second part of the Hartford's journey is all around the things that we're doing to address climate change. So that, typical for starters, we've been able to achieve 100% renewable energy use across our operational footprint when you factor in credits such as landfill gas consumption and onshore wind power and so forth. And we hit that mark last year, and we're on pace to do so again this year. In addition, 2 years ago, we announced that we were going to exit coal and tar sands, both from an underwriting perspective and an investment perspective. We gave ourselves until the end of 2023 to achieve that milestone, and we're on pace to do that. Particularly, in fact, frankly, we're ahead of it when it comes to tar sands. But on the investment side, that is going to require us to exit about $500 million of investments, including about $250 million in publicly traded investments. So not an insignificant shift for our enterprise around coal and tar sands. And frankly, that alone, that commitment has provided us with some internal momentum around broader sustainability efforts that have longer timelines attached to them, such as greenhouse gas emissions, where we've made commitments to hit certain goals by 2037. I think, as I think about the industry, I would say that the industry has worked hard and frankly collaboratively on driving greater resiliency and mitigation efforts. For example, predictive modeling and communications in imminent catastrophe scenarios has improved a lot. Insurers are working with governmental entities using state-of-the-art data. Similarly, industry advocacy for stricter building codes has gained a lot of traction at both the state and federal levels. And as far as climate-related perils go, we've seen advances in flood mitigation, research, and wildfire preparedness. So there's a good deal of momentum in that space, and it has a lot to do with public and private cooperation towards some of these common climate goals. I'll close just by noting, we recognize policymakers and regulators are taking a more active role in driving climate disclosure and sustainability disclosure more generally. We recognize that there is a worldwide regulatory response to climate change that's dynamic and certainly evolving. As it was mentioned earlier, Europe and the U.S. are in different places on that continuum. As a U.S.-based carrier, we think there's an opportunity for a better structure in the U.S. Than what we have now. And I think there are three principles that we that I think would help enable that a better regulatory structure. And the first would be, we hope the future structure finds some footholds in existing standards, especially as it relates to the business of insurance. There seems to be some momentum for that. For example, SEC Chair Gensler recently indicated that his team's looking at TCFD regime as a guide in setting SEC disclosure rules to come. So I think that's some potential good news. Second, it would be ideal if the disclosure requirements targeted, clear, ascertainable, measurable metrics, not just for ease of insurers to comply with, but to allow apples to apples kind of comparisons by regulators and other stakeholders. And third, since there's no standard for materiality on climate, ideally reporting would afford some flexibility to establish a materiality range that fits the regulatory need and is proportional to an insurer's size and complexity. So a future regime that builds on what we have now and keeps those principles in mind, I think would serve all stakeholders pretty well.
Thank you for those remarks, David. Certainly in terms of looking at the convergence and the need for consistency to the extent appropriate among regulators is certainly something that the NEIC is very much in favor of, and all of the work streams are really looking to build proportionate, consistent, and frankly realistic measures and metrics as we begin to think about what kind of additional disclosures ought U.S. insurers be making, and frankly what kinds of additional information and how might we enhance our solvency tools. So thank you for reinforcing that. Let me next introduce Louisiana Insurance Commissioner Jim Donelon. Commissioner Donelon has served as Commissioner of Insurance for the state of Louisiana for more than 15 years. Jim was elected as the president of the National Association of Insurance Commissioners in 2013 and currently serves as chairman of the Surplus Lines Task Force of the NAIC and on its executive committee. Jim has served the state of Louisiana for decades and served in the Louisiana House of Representatives, in which he served as chairman of the Committee on Insurance. And Jim, I know you play a very significant role on the NAIC's Climate and Resiliency Task Force as the head of the technology workstream. And we'd invite you to provide your opening remarks with regard to today's topic.
Well, thank you so much, Commissioner, and I truly also appreciate Commissioner Mays making this discussion available and giving us an opportunity to speak to what we have experienced as the various panelists come from different aspects of this issue, including myself as a commissioner of a state very susceptible to climate catastrophe events, as evidenced just during the past month. While at the same time, our state's economy is dependent, I might say, on the energy industry. And I'll touch some more on that during these remarks. But we at the Department of Insurance are concerned about hurricane risk for certain. I've long been a proponent of resiliency, strong building codes, and building higher to guard against flood risk, and building stronger to guard against wind risk. We have an incentive program in our state to try to encourage people to rebuild stronger so they are better able to withstand storms in the future. Insurers offer premium discounts when people fortify their homes to those higher standards. And I might add, we just saw from drone video the positive effect of building such facilities to the 150 mile an hour standard that was in place in many places along our coast, and the evidence of its success was dramatic. Meanwhile, our state has been working hard since Katrina to build or strengthen our levees, elevate our homes, and restore our coast, which is nature's buffer against hurricanes. Some $15 billion of America's taxpayer money was spent to rebuild the levees around the New Orleans area, which I have lived within my entire life. And other investments are planned or in the works in areas that were hit by Hurricane Ida. The department has a resilience coordinator, my Deputy Commissioner Warren Bird, who works with the governor's chief resilience officer, and we participate in the climate, as you said, and resiliency task force at the NAIC. Louisiana has laws that govern the allocation and quality of insurer investments, but these rules are about solvency and ensuring that insurers operating in our state have the money to pay claims when they're called upon to do so. Our investment rules are not about climate change. Rising sea level, and 12 years after Hurricane Andrew, and 8 years after Hurricane Isaac, and frankly 150 years since the last island event that was before Laura last year and Ida this year, the only hurricane in our state's history to be recorded at bringing 150 mile per hour winds. Those events, with the gaps in between, speak to the uncertainty of just what is causing and what is the answer to these issues. But we are focused on and committed to making sure that our state is able to withstand such challenges, however often they come into the future. Industry and regulators are just in the early stages of determining what assets are climate sensitive and understanding just what that means. While companies need to begin to consider what that risk may be, divestment strategies and reductions can themselves be very concerning from a solvency perspective. Initiatives that marginalize oil stocks could accelerate declines in their values, which could negatively affect the strength of insurers' portfolios. And our concern is having insurers that are financially sound. Insurers employ portfolio managers, and they should be the ones to decide what stocks are most appropriate to own. As a regulator, I shouldn't be dictating insurer investment decisions, but I should be mindful of the implications of such activity as I make these decisions. Rather than asking for divestment, however, I favor reinvestment in energy technologies that can provide long-term solutions that are cost-effective and climate positive, or at the very least, neutral. Assessing the potential impact to portfolio performance as a consequence of disinvestment in fossil fuels would be difficult, particularly for small to medium-sized insurers. It would require multiple assumptions about the long-term future of fossil fuels. Furthermore, most insurers licensed in my state try to maximize a tax credit against their premium taxes by making investments in Louisiana. On a more practical level, Louisiana is one of the top 5 states in both natural gas production and proved reserves. The state accounted for 9% of U.S. total marketed gas production in 2020 and has about 8% of the nation's gas reserves, according to the U.S. Energy Information Administration. Louisiana's 17 oil refineries account for nearly 1/5 of the nation's refining capacity and can process about 3.4 million barrels of crude oil per day. In 2020, Louisiana's 2 liquefied natural gas export terminals shipped out about 55% of U.S. total LNG exports. I might add that that port is located in Lake Charles, the city devastated by Hurricane Laura just a year ago. Continued access to natural gas and crude oil is part of everyday life here for now. And I can't see my way to cutting off Louisiana jobs and companies from investment dollars while their products are still very much in demand. With that said, Commissioner, I'd be happy to attempt to answer any questions you might have as we wrap up this introductory part of the panel.
Well, thank you very much, Commissioner Donilon. I'm going to introduce Sachin Shah and then circle back with some questions, but I think your remarks are critically important as, regulators have to look at the entire picture, and we have to look at all of the impacts of any regulatory activities that we take, and definitely want to get your take on that. But let me first introduce Sachin Shah, who is a managing partner and chief investment officer of Brookfield Asset Management, chief executive officer of Brookfield's Insurance Solutions business, and vice chair of Brookfield's Renewable Power Group. As CIO, he is actively involved in all investments made by the firm and oversees its growth into new lines of business. As CEO, he oversees a seasoned team focused on providing capital-based solutions to insurance companies and their stakeholders. As vice chair, he supports business development initiatives for the renewables business. Mr. Shah, would you like to make some opening remarks today?
Sure. Thank you, everyone, and thank you, Commissioner. We appreciate the chance to be here and to share our views. As background, Brookfield Asset Management is a global asset management firm. We have 2,000 clients around the world, typically insurance companies, pension plans, sovereign wealth funds who invest across a broad range of strategies that we offer. And one of those strategies where I'm deeply involved is our renewable power strategy. And to step back and then to tie it a little bit to the insurance community, we started investing in renewable power over 20 years ago, not as an environmental initiative, although it is the flavor of the day, but because we could invest and generate appropriate returns for our clients. And therefore, we started to grow a franchise in renewable power, in hydro facilities, wind farms, solar farms. As the cost curve of those assets came down, and increasingly over the last decade, I'd say, many of the clients who come to us looking for exposure to this asset class are insurance companies, or any company that has a long duration liability that they're trying to match cash flows against. And again, we didn't have an environmental objective at hand, and I'm just being forthright about that. We were able to build a business, a global business in renewable power, simply because the economics were attractive, and we had the operational and investment platform to do this on a global basis. And to give you a perspective of scale, our renewable power business, we have over $60 billion today invested in 5,000 renewable power facilities around the world. We have 3,000 people who operate our plants, who develop projects, who work with corporate clients to sell power on a long-term basis. And as I said, we bring a number of our clients, pension plans, insurance companies, and sovereign wealth funds around the world into this strategy so they can participate in the investment returns. From an insurance perspective, what is interesting is I would say over the last 5 to 7 years, many of the insurance companies who've come into this strategy at first were attracted to the stable cash flow profile, the duration, the ability to match assets and liabilities appropriately. And obviously, as environmental objectives globally have increased, and to your point earlier, countries have signed up to various global initiatives. The insurance community has also liked the fact that these investments meet their ESG requirements. What does that mean from our vantage point? I'd say, look, if you're investing in a general account as an insurance company, the first priority you should have, and we all know this, is protecting your policyholders and your clients. And I would say the skill sets that insurance companies have needed to build over many, many decades, even before the catchphrase of ESG or even the term global warming was around, insurance companies needed to assess their investments and make sure that the quality of the credit was strong over a very long period of time, and that credit could generate appropriate cash and could get paid back at the end of its term. And what I think is evolving in the space is that credits from companies that potentially are on the wrong side of climate change, at least based on today's view, the only question investors should be asking at this stage is there a risk to the cash flows I'm going to earn along the way, or is there a risk to me getting paid back my principal at the end of that period? That should at least be the first starting point. And then beyond that, investors and other stakeholders may have other objectives, but I think that is a fundamental or foundational point that I think all insurance companies should be grappling with today, and I think they are. And as a result, because of that, we've seen a significant amount of inflow into our renewable power strategy, given it provides a safe domain and a safe investment opportunity where people feel that the back end is protected. So maybe I'll pause there and see if you have any questions in that regard.
Well, we certainly will. I think one of the things that you're saying that's really also critical to understand is that this is not just a run away from strategy. This is a run toward strategy, with the idea that fundamentally, what insurance companies have to be about in their investment strategy is yield and safety. So, those things can combine in renewables. So, I know that uppermost in the mind of many carriers today, particularly given the Biden administration's executive order, the activities of Treasury, FSOC, FIO, and of course the NAIC's own activities, is what are regulators doing and what are regulators going to do, particularly with regard to assets and an evaluation of assets that are carbon sensitive. And so let me first ask a question of Commissioner Donnellan. Do you think that U.S. regulators should begin to require companies to at least assess the impact of climate and government actions with respect to their investments? And if so, what kinds of requirements do you think might make sense today?
Surely, and thank you, Commissioner, for that question. And back to a decade ago, you mentioned I was president of the NAIC back in 2013, and my predecessors, Commissioner Voss of Iowa and McCarthy of Florida, led the effort to get U.S. regulators to require insurers to assess their investments in several different ways, beginning with the rollout of what's now called ORSA, the Own Risk and Solvency Assessment, which is filed with regulators, as well as the ERM, or Enterprise Risk Management, of which an important part is Asset Liability Management, or ALM. Asset Liability Management is the management of assets to ensure they're available to pay claims as they arise. We also require insurers to have formal investment policies and to comply with state investment laws, generally the model law for qualified investments, which I believe, I know my state does, and certainly yours does. I dare say every state does, as an accreditation standard back to the 90s by the NAIC. We should require companies to assess the impact on investments of all major risk and of government actions related to them, not just those related to climate. For example, cyber risk presents a similar and more direct and imminent threat to insurers' operations, underwriting, and investments, and there are government actions related to cyber risk that will have a substantial impact on insurance going forward. In the solvency world, the current risk-focused examination and analysis approaches allow regulators the ability to assess insurers' awareness and mitigation strategies related to climate change and recommend improvements where necessary. Insurers should be encouraged to include climate change as a component of their investment policy so that they are aware of the risk and can develop strategies to mitigate that risk. It is also incumbent upon the NAIC for us to give analysts and examiners additional tools in which investment risk related to climate change can be assessed and monitored. It is also incumbent upon insurers to make this assessment in light of the jurisdictions in which they operate. Should a jurisdiction prohibit investment in certain companies or sections, it could greatly inhibit an insurer's ability to successfully execute its business plan. That, in summary, summarizes what I see from the perspective of a state that not only is threatened by rising sea level, which is well documented, but is also a threat to us because of a unique to our state subsidence of our landmass and loss of our coastal barrier islands and batchers that have been eroding significantly over the past couple of decades.
No, very well said, Jim. I mean, I think we all need to be very thoughtful and careful about the idea of, prohibitions and imposing, certain particular standards or at this level or at this point concentrations on any carrier because of all of the rippling effects that can have and the transition risk that exists. I know one of the things that we've talked about as U.S. regulators is also the idea of being gradual, incremental, practical. And along those lines, one of the things that's important is to look at both regulatory regimes and other regimes that carriers are already part of. And to that end, Jeff, I'd like to ask you a little bit about sort of how the risks of climate change affect insurance company ratings, because today rating agencies are looking very closely at risk mitigation strategies by carriers with respect to their credit risk. So carriers are already working through those issues with their rating agencies, and I think we can learn from and borrow from that as we begin to direct companies to make these at least initial analyses of their investment risk. So could you speak to that issue?
Sure, and I think this is a common theme that the various speakers have talked about is just the different time horizons. So our rating opinion really is projected over the next 2 or 3 years, because that's where we think we can adequately predict what's going to happen. Whereas climate change is really a 2030, a 2040, a 2050 year event. So we have a little bit of a duration mismatch. If we go back to Jim's ALM discussion is, today climate change is not really an issue, but today's generation, climate change will be an issue. And by no means does that mean that we have to stop and try to kick the can down the road. But as I think all the panelists have talked about, we need to be more measured. So as I mentioned earlier, a couple of years ago, we created what we call these ESG relevance scores. And in our universe, we only have 2 companies which scored in the 4 category, which meant that weather, maybe not necessarily climate change, but weather, and in this example would be hurricanes, would have a direct effect on their ratings. That if we saw significant multiple hurricane activities of significant size, their balance sheet could be severely impacted, and that would lead to rating downgrades. But to physical rating actions, none have been occurred yet, but we do have our eyeballs on a couple of entities that are in our universe. The challenge here then, and what we've started to take a look at, is as these reporting requirements kind of coalesce, as I think David mentioned, can we start taking a look at incrementals? What is the company doing over the next 10 years? What is the company doing over the next 20 years? What is the company doing over the next 30 years? And as those reporting requirements and measurement activities kind of come in together, then that gives us a little bit better predictability. But at this point, to try to say the effect of climate change on a particular company in 2050 is purely speculation and really adds no value at this point to our investor base.
Well, thank you, Jeff. I think that, as you talk about the time horizons, that's some of the discussions we've really had around ORSA as well, right? Because it's an instrument that's really looking at a much shorter horizon. And yet, as we think about systemic and long-term risks, how are we evaluating and analyzing and preparing today for the future? And, David, I was interested as you were talking about the Hartford's objectives and the timeframes, and sort of contrasting that with some of the things that Commissioner Donilon was just saying, because at least with respect to certain types of investment, you do have a divestiture strategy. And that differs in some ways from what you've seen, like, for example, the Net Zero Alliance, that may not be just divestiture oriented, but rather, developing enough of a sort of concentration of shares in an entity to direct, that entity's own strategy with regard to certain types of carbon-related activities. So I'm interested in, as you've given us the sort of Hartford story on climate, how do you think that the industry's climate and or sustainability strategy will change in the wake of some of these greater disclosures and reporting requirements? What kind of advantages or gaps, and maybe speak a little bit to sort of the Hartford's view of divestiture?
Yeah. So maybe I'll start there and then go to sort of the future. While we did come out a couple of years ago with our coal and tar sands policy, as an insurer and an investor, we are actively targeting opportunities for investment to deepen our relationship with companies and to actually support projects that can promote energy efficiency. So we're kind of looking at it from both angles. I mean, there are places, I think, where we can from an investment perspective divest, but there are increasing opportunities for greater investment that we see both today and on the horizon. When it comes to kind of the changes and are we as a company and we as an industry ready for the changes that are going to continue to come in the sustainability front, I guess I'll start with a comment about the Hartford and then maybe a thought about the industry. I think we are as well positioned as we can be for what might come next. Our existing disclosures, our existing reporting on these topics is pretty comprehensive. I think it paints a pretty good picture of our climate efforts and our plans, our commitments right now. And I don't see any gaps at the moment. And I think it's built to change going forward. I would tell you that internally, how we manage sustainability, we have a a dedicated committee made up of a cross section of leaders from across the organization, because this doesn't just touch underwriting or governance and disclosure or investment. It touches human capital issues. And so we've created a sustainability committee. And underneath that sustainability committee are subcommittees. You mentioned that I chair our environment committee. There's one on human capital. There's one on investment, underwriting, and so forth. So we really are trying to weave it into the very fabric of the company from end to end. And then from a board perspective, our nominating and corporate governance committee oversees the governance of how the company manages sustainability, ESG, environment issues. And then the full board actually owns the oversight of sustainability. So it's not delegated out to a committee. The board feels it's that important to find that right balance. So I think that structure too is built to address what comes next. From an industry perspective, we also pay a lot of attention to what our peers are doing, and we're not above learning from our peers and how they're attacking this issue. And as I noted earlier, I think the industry's done a good job of working appropriately together and with regulators and governmental entities on the crucial climate resiliency that Commissioner Donlin mentioned, mitigation initiatives, but I do believe that these standards coming together, if they can come together in a clear, simple way, can benefit all stakeholders going forward.
Really critically important. And that balancing act and that movement and the timing of the movement is so critically important. And, Sachin, I'd really like to turn to you on that. Brookfield is one of the world's largest alternative asset managers, and you have really a track record with regard to movement into renewable energy investing. And so really like to hear from your perspective, how important is it for asset managers to provide insurers with an opportunity to invest in ESG compliant assets? And sort of, what does that pathway look like?
Yeah, it's a good question. I'd say much of this has come from our clients, as I said, we started out investing in renewables not as a dedicated strategy. In fact, we invest in pipelines and midstream assets. It was part of our broader energy strategy. But as I said, over the last 5 years, increasingly clients of ours, insurance companies, limited partners, pension plans, others, were saying, can you carve renewables out as a separate dedicated strategy? Because we have our own internal ESG criteria. And that's not dissimilar to what's happening in the public markets, where institutional and retail shareholders are also feeling or pushing investment managers to identify assets that are environmentally and socially acceptable to them. So I think there is a combination of the push from the client side and then the pull from the regulators and the governments. And as investment managers, we are all trying to build our franchises to respond to that. But fundamentally, it comes back to risk. And it's just one risk of many risks that we manage. Commissioner Donnelly mentioned it. And we also look at cyber risk. We also look at all of the other risks that are out there, litigation risk if you're a tobacco company, all the things that can present unique credit events. And I'd say today, I don't think you can look at the environment as a siloed risk. There is a broad array of risks as an investor that you have to look at. This is one really important one because the level of regulation and government intervention in this particular area is stronger than anything we've ever seen before. And that's a risk in and of itself to the companies that are on the wrong side of the argument. So we're looking at it from that vantage point. We're trying to be a good fiduciary to our clients and respond to the needs that they have to have investment products that are friendly in this regard. And And fundamentally, the reason we can do it is because we've built an organization that knows how to invest in the space and can generate a proper return. We wouldn't do it if we couldn't generate a reasonable return relative to the risk profile of these investments.
Well, thank you. And, again, Commissioner Donilon, you speak, eloquently to sort of the need for proportionality, the need for a measured approach, and sort of regardless of how laudable goals may be, you don't want to gut an industry and gut a set of jobs and within a particular state. And so, I guess as you're balancing your various hats in Louisiana and the NAIC, can you speak a little bit more about what it means to be looking at investment portfolios with regard to certain sectors?
Surely, and I, in my own mind, am mindful and remember well the tobacco industry and our friends in North Carolina and Kentucky and other states that saw such impact from the litigation and the activity that followed that litigation a couple decades ago. My primary concern here in Louisiana as the regulator is to not try to substitute our business judgment for that of the management of insurance companies, also a vital industry in my state. We have no greater insight than others on issues that are outside of our purview. Transition risk arises from, quote, disruptions and shifts associated with the transition to a low-carbon economy, which may affect the value of assets or the cost of doing business, quote, unquote. The transition risk most often raised is the problem of stranded assets or legacy assets that have been held too long during the transition. Stranded assets become a liability, in effect, when they are not performing as investments and no suitable market for their sales exist. There are some regulators who feel that fossil fuel investments will soon reach the point of being stranded assets that weigh down the balance sheets of insurers. Given that fossil fuels will be a major part of the energy supply for the foreseeable future, it is premature, in my judgment, to demand divestment of those assets solely on prudential grounds. Fossil fuels pervade the economy in a way tobacco, for example, did not, and it will take a long time to transition. Premature requirements to divest from fossil fuels could have cascading effects throughout the economy that we can neither anticipate nor manage as insurance regulators. Insurance regulators should not be taking possibly ill-informed actions that will add to the inherent risk in any such transition.
So, I'd kind of like to throw out to the group is, do you think that insurance companies, have a handle on the investment risks of climate change and, looking at some of the unique challenges that insurers face, at least with respect to investments, are they ready for a more regulated world on climate? Jeff, let me start with you.
Generally, I would say yes, but I think as David kind of alluded to earlier, I think there's a number of companies that are at different parts of their journey. So there are companies who have been focused on, as Sation has said, for a number of years, 10, 12 years. And then there are other companies that have just started on this journey. So generally, I'd say yes, but maybe in aggregate, because you have smaller companies, smaller insurance companies that kind of need to wait for leaders like the Hartford to kind of forge that path. I think generally the industry may be a little bit on the backside. But I think as we've alluded to earlier, you kind of have to kind of focus on maybe particular sectors and so forth. And I think we alluded to earlier that Europe with a more cohesive regulatory spot is a little bit farther ahead than U.S. companies. But I would say the same thing as we've talked to companies. There are certain companies that just love this stuff, and they'll talk for a long time about it, and you can tell where they are. And then there are other companies that are a little bit, we're thinking about. So you can kind of see that they're a little bit more measured. But generally, we would say that the life insurance sector, because of their long duration, and we've alluded to earlier, the asset liability management structure of life insurers, they're more keenly focused on climate change because they know that over the long term, they need to be aware of how climate change can affect those particular assets. Whereas P&C side, we see them focusing a little bit more on the underwriting side, because their assets are more short, more liquid. They need to pay policyholder claims fairly quickly. So they can be a little bit more nimble with their asset class, with their views on climate change. But I think we're all saying the same thing, that there are certain tools, that whether it's the RBC formula and certain companies get downgraded because of their climate activities, that's going to show up. We have the ORSA, we have the ALM features. So there's tools that companies can use, and now it's just a matter of gathering that data and then applying that data to certain models to help measure future activity.
No, thank you. David, what do you think?
Jeff, I think there's a deep understanding across the industry around the risks we write and the investments we make, and a growing understanding of what both of those things, the assets and liabilities, mean from an environmental perspective. I think, though, layering on top of that is an ever evolving reporting regulatory world, which I think we all accept. And listen, the Hartford, we're a multi-line carrier with an investment company and a mutual fund company, so we're used to kind of balancing those different regulatory regimes. But I think we are eager to turn the page on climate reporting and maybe even more broadly sustainability reporting to an environment that driven by regulatory reporting that's specific and directive. I mean, even recently, I think if you had to count them up, there were something like 600 different data gathering private actors in the sustainability space. Many of them focused on environment and climate, and relatively few that really sort of applied those data gathering requirements to the business of insurance. So we had to kind of pick wisely through those as to make sure which ones we're responding to that we think paint a fair representation of our assets and liabilities. And that's where I take some comfort from the broader adoption of SASB reports and TCFD reports that are driving some greater consistency, which again, I think is good for us. We've got a stable set of criteria to report against, and I think is good for all parties involved.
Sachin, what do you think?
I think, and I come at it from an investment mindset. I think the market should decide what the appropriate cost of capital for different investment products is, and if the market starts to increase the cost of capital of investments that are perceived to be less climate friendly, that the market will do that. I think personally, it's a slippery slope if insurance regulators intervene too much in this regard. I think insurance companies and investment management teams at insurance companies manage a multitude of risks, and this is another risk. And disclosure obligations and those things will come through regulation, but as it relates to the actual investment mandates, I would err on the side of letting the market decide what these securities are worth, and letting investment management teams manage to their risk profile and to their ALM requirements in the spirit of protecting policyholders. And obviously governments will do what they'll do. So that's a whole separate agenda, and that's not something that I think any of us are here to talk about. But that would be my view, if you ask me.
No, well said. And I think we live in an environment where, frankly, I don't know what exact tools or models we would actually use in order to impose regulatory requirements at this point, particularly when you get down, to talking about and trying to somehow not just identify which ones may in some way, to some extent, be sensitive to carbon, but looking at, so what does that mean? how do we address that? And so we don't really have those kinds of tools. Companies, even the largest of companies, are still working through models to assess internally the extent to which they're concerned about particular investments. And so, to your point, we're really not at a place where those people who are even the most experienced in asset management can get to a sort of a role where you would have a classic insurance regulatory regime about particular investments and concentrations or RBC charges. That's just not, we're not anywhere near that responsibly today. And I know, Commissioner Donilon, that those are views that you share. So let you have the last word on sort of this topic of how we address asset and asset management in the context of climate change risk.
Surely, Madam Chair, and thank you so much, Commissioner, for allowing me to be part of this very robust and I think very informative discussion that we've had here this afternoon. And let me echo what Sakin just said. The market will ultimately determine where the money flows relative to investment portfolios. And we regulators should be very mindful of our role and stay in our lane, as one of my former colleagues was constantly hammering home. We are not policymakers. That's Congress, that's legislators, governors, and presidents. We are regulators. They make the rules. We implement and oversee the industry we regulate as they abide by those rules. And it will take care of itself. The market will determine the future of those portfolios that include significant fossil fuel investments. And we in Louisiana, dependent on that industry and also very at risk for adverse catastrophic weather events, are right in the middle and very mindful. Our governor, our legislature, our congressional delegation is very focused on resiliency and the threat that rising sea levels and the subsidence of our topography in our state represents to our citizens. So thanks again for including me in this. Commissioner Mays has truly brought together an impressive group to not me, but the experts who shared their experience and knowledge on this subject and put together a very balanced and informative forum here this afternoon that you so ably led on this very, very important and challenging subject.
Well, thank you, Commissioner, for your contribution. Thanks to all of the panel members. This indeed has been a great discussion. We are all very grateful for the Connecticut Department and for Commissioner Mays for their leadership in putting this together. And I want to thank you all for joining us here today.
Hello, I'm Chris Swift, Chairman and CEO of the Hartford. I'm pleased to say that the Hartford has called Connecticut home for 211 years, and the state continues to be a great place for insurers to do business. I want to thank Connecticut's Insurance Commissioner, Andy Mays, for his leadership in convening this forum and express our appreciation for everyone involved in the panel discussions. The forum's exploration of the insurance industry role in addressing climate change is both important and timely. At the Hartford, we are very proud of our deep and longstanding commitment to sustainability. We know that our ability to effectively underwrite risk and provide resilient insurance solutions is critical to meeting evolving customer needs. Helping people prepare for and adapt to climate change is essential, and the insurance industry has a critical role to play. Our company is continuing its own journey on climate change. Our priorities include 100% renewable energy across our operational footprint and year-over-year targeted reduction in greenhouse gas emissions through 2037. Further integration of ESG principles across our underwriting and risk management practices by increasing written premium in products that support a responsible future. Exiting tar sands holdings by the end of this year, 2 years earlier than our initial commitment, and exiting holdings which do not support our coal policy by the end of 2023. And finally, we're addressing stakeholder demand for increased climate disclosure through TCFD, ClimateWise, and CDP reporting, while engaging and educating our employees and policymakers and community stakeholders in advocating for climate mitigation. We have seen the devastating toll that recent climate-related events take on our community around the world. And we are determined to use our resources and influence to help address the evolving challenges brought on by climate change. Thank you all for your focus on this critical issue.
Good afternoon. Thank you to Commissioner Mays for inviting me to address the Connecticut Conference on Climate Change. My name is Anna Sweeney and I'm chair of the Sustainable Insurance Forum. An event such as this is an excellent example of connecting regulators, academics, advocates, industry and other leaders to discuss how to enhance climate resilience. Indeed, with our virtual participation, we're able to benefit from a wide range of international perspectives on what is undoubtedly a global issue. I'm delighted to be here representing both the Bank of England and the Sustainable Insurance Forum. Having been set up by Commissioner Dave Jones of California in 2016, the CIF has gone from strength to strength under the leadership of Jeff Summerhays as a global network of insurance supervisors working together to strengthen responses to sustainability and climate change challenges, all facing the insurance sector. Since taking the role of the chair of the CIF, I've been struck by the degree of awareness and commitment to action on climate and sustainability issues from regulators globally, and including here in the States. It is clear that this commitment to action is what's needed. Climate change is an existential and present threat. The most recent IPCC report catalogued how its impacts are already being felt. Tackling climate change requires a collective global response if we're to meet the targets set in the Paris Agreement. The pace of climate change and the need to manage its consequences and reverse the current emissions trajectory represent both a challenge and an opportunity for the insurance sector. Insurance have an extremely important role to play in both underwriting new risks and financing long-term investment in climate adaptation and mitigation measures. It's a challenge unlike any other and demands clear action. When it comes to climate risks, we're beyond the debating phase. Events such as this show that regulators and supervisors have an understanding of how climate risks manifest and have become much more focused on actions to deal with them. And the calibre of the participants over the 2 days here underlines how seriously the industry is taking it. Significant steps have been taken across the supervisory community to establish expectations around climate risk management, and more is expected. Firms themselves are building their internal capabilities to better measure, price, and manage climate risks, while also exploring the development of new services and products in an effort to mitigate climate-related protection gaps. Insurers and regulators have a shared responsibility to continue to advance their thinking and to take action. Neither industry nor the regulatory community have an obvious advantage in terms of information or experience of climate risks, and so the most effective response will be one in which everyone plays a part. The pace of change will only increase in the build-up towards and hopefully beyond the UN COP26 summit in Glasgow. To illustrate how far this momentum has already taken us, in 2015, we at the Bank of England published a report that provided a framework for considering the risks arising from climate change through the lens of the PRA's statutory objectives in relation to insurers. This was followed in 2019 when the PRA published supervisory guidance setting out its expectations on how insurers and banks should approach the financial risks arising from climate change. The supervisory statement encourages insurers to focus on 4 aspects, in developing an enhanced approach to managing climate risks: governance, risk management, scenario analysis, and disclosure. The Bank of England might have been amongst the first to publish these kind of expectations, but we've certainly not been alone. With the support of the IIS, the membership of the UN CIF is at the helm of the supervisory response to climate and sustainability challenges facing the sector. Since its formation in 2016, as a small group of forward-looking supervisors, seeing the challenges that were coming down the line, the CIF now has 33 members from all over the world. This network facilitates knowledge sharing, dialogue, and policy innovations to address climate risk to insurers across the globe. Combined, the network now represents over $5 trillion in gross insurance premiums and covers 92% of the global market. The CIF has increasingly become a strongest voice for insurers in this space and an important representative for insurance supervisors and regulators at fora such as the NGFS. Thanks to the collaboration of its members and its close partnership with the IIS, the CIF's achievements over the last few years include the launch of the public version of the question bank on climate change risks to the insurance sector, which means the industry now has access to the types of questions that supervisors may ask entities regarding climate change financial risks. A joint issues paper with the IIS on the implementation of the recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD. The recently announced Climate Training Alliance. This is a collaboration between the CIF, IIS, the Bank for International Settlements, and the NGFS. And it will bring together authorities at the cutting edge of climate risk management to share experience and training resources with the rest of the central banking and wider supervisory community. This reflects a continued focus of our work, building the skills and capability of supervisors everywhere. And a joint CIF-IIS application paper on the supervision of climate-related risks in the insurance sector. Published in May this year, the application paper reflects the existing international supervisory framework developed by the IIS, outlining the ways in which financial risks from climate change can manifest within established risk areas. Supervisors and insurers alike can take insights into how to address climate risks through supervisory reviews, corporate governance, risk management, scenario analysis and stress testing, as well as investments and disclosures. The events that form Connecticut's Conference on Climate Change and Insurance and the expanding reach of the CIF suggest that many of the regulatory community are already invested in coordinated global action. Let me set out why I think a harmonised international approach is so important. It creates clear parameters for firms across the financial system and operating across jurisdictions in setting their strategy to respond to climate risks and sustainability challenges. And a consistent regulatory approach reduces the likelihood of a competitive advantage emerging in those jurisdictions that are not enforcing the same standards. Having said that, I think a little bit of healthy competition amongst regulators to learn from each other and to do better is always a good thing. I'd like to reiterate some remarks I made recently concerning disclosure. Effective disclosure of climate risks is a crucial tool in promoting risk management and market discipline. It provides meaningful information to policyholders to make decisions on insuring risks, to market participants to make decisions about providing resources to an insurer, and to enable comparison between firms. The recommendations of the TCFD have become the global standard for voluntary disclosure of climate risks and opportunities, and the implementation of these standards is becoming more embedded across the globe. As well as the UK, a number of regulatory authorities have leveraged elements of the TCFD framework in setting supervisory expectations. Those are from around the world, including APRA in Australia, the Monetary Authority of Singapore, and the European Commission. In the US, we're aware that a number of state-level regulators are working together to reference the TCFD recommendations within the NAIC Climate Risk Disclosure Survey and mandatory initiatives in several states. And in a letter to regulated CEOs late last year, your neighbour, the New York DFS, set out its expectation that all regulated firms start developing their approach to climate-related disclosures with reference to the TCFD recommendations. Given the urgency of the climate crisis, a voluntary approach may not be sufficient to yield the quality and consistency of climate disclosures to enable market participants to make decisions about how insurers are taking action on climate change. Although insurers are generally considered to be slightly ahead of peers in the wider financial services industry, not least because of their insurance of natural catastrophe risks, only 15 to 20% of insurers have made plans or are already implementing the TCFD recommendations. In 2020, New Zealand became the first country to propose legislation making TCFD disclosures mandatory for financial institutions, and the UK has set out its own roadmap towards mandatory aligned disclosures over the next 5 years. This commitment to increasing transparency at a jurisdictional level is a great step forward, but an internationally harmonised approach will be critical if we want to get comparability and consistency across institutions. The CIF with the IAIS has progressed this work through this application paper on the supervision of climate-related risks. The paper sets out guidance to assist supervisors in implementation and provides examples of good practice. It includes references to the IAIS standards that are most relevant in determining how comprehensively insurers have publicly disclosed the interplay between climate risk and their own business profile. Through this paper, the CIF is aiming to promote a globally consistent approach to addressing climate-related risks in the supervision of the sector, including through disclosure. But market discipline, supported obviously by disclosure, and monitoring of risk is only the first layer of a prudential response to climate risk. I spoke recently about the overall resilience of the UK insurance sector, and my remarks were predicated on a 3-pillar regulatory framework, comprising disclosure, risk management, and capital requirements. In the case of climate, I think of these 3 pillars as a progressively deeper embedding of the realisation that climate change is a genuine risk and should be treated like all other risks that firms are facing. Stage 1, you recognise that climate change is a risk, but you don't know much about it, so all you can do is report on it through the Pillar 3 disclosure. Stage 2, you classify and systematise your understanding of the risk, embedding it in your own risk management, Pillar 2. Stage 3, you follow this greater understanding of the risks by ensuring your risk-based capital calculation is consistent with what you've learned. I've talked about disclosure and integration of climate-related risks into insurers' governance and risk management has been another core area of regulatory and industry focus. In the UK, we expect firms to fully embed climate risks into their operations by the end of 2021. Stress and scenario analyses are also a vital tool as part of this risk management for insurers to meet these Pillar 2 obligations. Without the exploratory scenario from the PRA's 2019 insurance stress test, we wouldn't have any insight into the potential extreme physical climate change scenario. A 1 in 100-year loss may in future exceed today's 1 in 1,000-year loss. By sizing the financial system's exposures to climate-related risks over the longer term, we can identify how firms need to respond now to ensure they remain resilient over the coming years. As a result, a number of regulators are now integrating climate scenarios into their supervision of insurers. Although we're not currently using climate scenario analysis to directly set capital requirements, that's not the objective of either our historic scenarios or the current biennial exploratory scenario that we're currently working on with banks and insurers. As a prudential supervisor, our aim is to ultimately embed climate risk across all supervisory areas. We know that there is increasing appetite among insurers to invest in green assets, but the potential for greenwashing and lack of data on newer asset classes make this challenging. We expect firms to think about how climate impacts both sides of the balance sheet. And as with all risks, firms should be forming a judgment-based view on whether capital should be held against climate risks. We should be open to the possibility of factoring climate risks into capital requirements. Although I should say at this stage, I don't think the case is yet proven. In the UK, we'll be considering options for whether and how to embed climate risks into capital policy. And it's sensible to start by assessing the extent to which existing capital frameworks currently include climate considerations or have the capacity to do so. For example, credit ratings are the central metric in the UK's regime to determine the riskiness of fixed income assets. If credit rating agencies more comprehensively account for climate and sustainability considerations in their credit assessments, which seems to be the direction of travel, there would be a direct impact on many insurers' capital requirements. This is certainly one of the minimum factors that the PRA expects firms to consider when conducting their own internal credit assessments. This might not completely reflect the end state we want to get to, but it's certainly a good exercise to start with. I began my remarks today with the observation that awareness amongst the regulatory community of the financial risks from climate change and the commitment to act has increased significantly, and I hope that this momentum continues. But regulatory action isn't the only means to make progress. We should encourage public-private partnerships like the Insurance Development Forum, which can mobilise the insurance industry towards a more ambitious climate resilience agenda. The IDF is actively engaged with the COP26 agenda and deliverables, where the insurance industry can specifically contribute, optimising the use of insurance and its related risk management capabilities to build greater resilience and close the protection gap in climate vulnerable countries, or indeed in climate vulnerable parts of countries. It's easy to become overwhelmed by the myriad developments across the climate change and sustainability landscapes, as well as the limitations that we, both regulators and industry, face with data and modelling tools, particularly as new challenges continue to present themselves on the horizon. The CIF has identified biodiversity loss and nature-related risks alongside climate change as a leading environmental threat to financial stability. We'll shortly be publishing a scoping study on nature-related risks in the global sector, outlining the risks posed as well as the responses required from both insurers and supervisors. This work follows leading work by our colleagues in the Netherlands, the DNB, who've already produced a report exploring biodiversity risks for the Dutch financial sector. That study estimated that 36% of all investments from Dutch financial institutions would be lost if ecosystem services underpinning them were no longer available. That's a startling fact, and one which highlights the complexity and uncertainty that still surrounds the extent and depth of sustainability issues. If the world is to have a healthy, sustainable future, every industry must be looking to how it can contribute. Meeting the targets laid down by the Paris Agreement is going to be difficult, but it's essential. And COP26, we hope, will be a fantastic opportunity to work towards this vital aim together. The insurance industry is well placed to play its part. No single actor can solve these issues alone. The commitment through the CIF and IAS, amongst others, to coordinate action and share best practice to learn from each other is essential given the global nature of climate change impacts. Both through sharing existing expertise and researching new areas, we can and must build a global insurance system that can appraise climate exposure, provide appropriate cover to everyone at risk, and thorough risk assessment and innovation through assessment and innovation help reverse climate trends. Furthermore, collaboration between the global regulatory community and the insurance industry is vital. Private and public actors must equally play their part to help rewrite the climate narrative unfolding on the horizon. The challenges that face us are vast, but not insurmountable if we act now. It will take cooperation and concerted effort, supported by governments, academics, and private enterprises throughout the world, as well as the regulatory community. The Sustainable Insurance Forum is one of many such bodies seeking to bring these skills and resources together, and the insurance industry can cooperate to help fight this battle. The present threat of climate risk demands a global collective response, and we all need to play our part to mitigate the financial impacts of climate change. Thank you for your time today.
It's hard to believe that there are still those who deny that climate change is happening. Over the past year, we've seen a third of our nation underwater, a third of it on fire, and a third of it without water. Climate change is happening now, and we must address it. This is the practical reality of what our planet faces. While the changing climate alters the world as we know it, climate deniers persist. We cannot afford to ignore reality, and I refuse to do so. Science still matters. It's how we are fighting COVID-19, this global pandemic, by masking and getting vaccinated, even as we face a public health crisis. Those denying science put our nation at risk. In Congress, I'm an original co-sponsor of the Green New Deal because we must act now to combat the climate crisis. I also introduced the America Wins Act, legislation that would tax pollution at its source, carbon emissions. My legislation would meet President Biden's bold greenhouse gas emissions reduction goals and exceed our nation's commitment to the Paris Climate Agreement. The climate crisis is one of the largest existential threats we face, and it requires bold action. We must look to solutions at all levels, like conservation, something we can all reflect upon in today's consumer-driven economy. I applaud the Department of Insurance for holding this very important conference and look forward to following their work on this issue.
Hello, everyone, and welcome to the Connecticut Conference on Climate Change and Insurance. This is the panel on underwriting. I am Dennis Burke, Vice President of the Reinsurance Association of America, the RAA, which represents reinsurers who insure insurance companies for catastrophes and other large losses. We have an interest in the impacts of climate change. Today, I'd like to thank the Connecticut Insurance Department and Commissioner Andy Mays for hosting this important conference. I'm happy to be here today with a distinguished panel of climate and insurance experts. Today, we'll be discussing several issues around climate change, its impact on insurers, and their underwriting. We will explore the impact of climate change on insurance regulation, investors in insurance companies, and the role of insurers as society transitions from its use of fossil fuels to more resilient energy sources. On our panel today, we have a state regulator, an investor advocate, a representative of an insurer, and an experienced consultant specializing in advising clients about climate issues. Our first presenter today is South Carolina Director Ray Farmer. Director Farmer has been the director of the South Carolina Department of Insurance since 2012. He is the immediate past president of the NAIC, the National Association of Insurance Commissioners, and brings an amazing 53 years of experience in the insurance industry to his leadership role. In 2017, Mr. Farmer received the Order of the Palmetto from South Carolina Governor Haley, the state's highest civilian honor, for his extraordinary lifetime service and achievements in national and statewide significance. There are many more achievements over the 53 years, including the fact that Director Farmer oversaw the first state to pass the data security law, the insurance data security law, which he chaired and oversaw the development at the NAIC. Director Farmer will provide an overview of current regulatory environment, including actions under consideration. Director Farmer, the floor is yours.
Thanks, Dennis, and thanks to Commissioner Mays for having this extremely important conference, although virtual. One day we'll all be back together, and quite honestly, I can hardly wait for that. Dennis, when you become president of the NAIC, the NAIC allows you to pick a topic that will be the main focus of your year as president. So I picked two. One topic that we had to finish up on that under Superintendent Chapo had already started, and that's with probably our most troubled line of insurance in the country currently is long-term care insurance. But my real topic that I wanted to focus on was climate and resiliency. And so we did that starting in January, and we developed 5 work streams as we went along, and I'll discuss those in just a second. But we were going along our merry way in January and February, and then all of a sudden COVID hit in March, and then the NEIC focused on all things COVID all the time. And then as we were getting used to working at home and doing things different because of COVID, we had the civil unrest, the social justice issues, and the death of George Floyd. So we immediately pivoted to that and addressed initially in that effort for the NEIC's Executive Committee on Race and Insurance will continue for years to come, and that is probably one of our more significant efforts of all time in the 150 years that the NEIC has been in existence. But by summertime, we were able to refocus our attention on climate and resiliency, and we did that. And as I mentioned earlier, we have 5 different work streams. And I'm going to briefly hit those because they are extremely important, and each one of them are up and running and doing a great job. So first, as you would expect, will be a solvency work stream, and Commissioner Bahrain from Maryland is chairing that important group. They've spent much of the past year developing an understanding of the risk presented by changing climate patterns. This work stream is looking for opportunities to enhance regulatory solvency tools to specifically address climate issues, and they'll be exposing their recommendations hopefully by the end of the year. And then we have a technology work stream led by Commissioner Jim Donlan of Louisiana, and they're exploring ways to look at catastrophe models to assist state regulators as we look at models ourselves, and they'll help us coordinate resources. Hawaii Commissioner Colin Hayashida leads an innovation work stream, which is developing information on parametric products to fill in coverage gaps caused by natural disasters. And then under the leadership of, the Oregon Commissioner Andrew Stolfi, he chairs the climate risk disclosure work stream, updating the NEIC climate risk disclosure survey, which was developed back in 2009 to understand how insurers are considering climate risk within their business operation and risk management strategy. And in doing that, they'll be looking at the international standard TCFD and seeing how the NEIC current survey and TCFD is there a way to either have one or get closer, so there's not so many different surveys. And then finally, Wisconsin Commissioner Mark Afable is leading a pre-disaster mitigation work stream, which has developed a list of mitigation actions for all perils, working with the industry and consumer groups to conduct consumer outreach on mitigation. It's a proven way to reduce property damage, provide better life safety. FEMA will tell us that for every dollar we spend on pre-disaster mitigation, we save approximately $6 after a catastrophe occurs. So all these work streams are actively engaging in the important work of ensuring our industry and that we're continuing to prepare and respond appropriately to environmental factors. Truth is, Dennis, every state has some sort of climate peril, some catastrophe, whether it's wildfires, hurricanes, tornadoes, floods, earthquakes, you name it. Each state has some peril that we have a strong interest in preparing our marketplace and our citizens when those occur. So our common goal is to expand the insurance market for each type of catastrophe, thereby increasing competition and providing additional options for consumers. And our free market system competition addresses a lot of the ills in the marketplace and, quite honestly, society sometimes. But we all know that FIO, Federal Insurance Office, has been tasked recently at looking at gaps in the supervision and regulation of insurers. So that's a big concern at the NAIC, but we have willingly engaged the conversation with FIO. We've had first of what we hope are many conversations, many discussions. But it's important to know that the NAIC is made up of 56 unique, diverse jurisdictions. Each one has a unique economic and catastrophe peril interest. We've done significant work over the last 15 to 20 years, and our hope is that this new effort will serve to empower the work that states are doing rather than undermine it. We're all in this effort together. The FIO needs to recognize the efforts that the NAIC, the great efforts NAIC has done over the last 15 to 20 years. But we remain committed to working with the state and federal and international stakeholders to coordinate climate-related risk and resiliency assessments, disclosures, and evaluation initiatives. So each state has the information, policies, and tools that promote resiliency and ensure stable insurance markets for our individual citizens.
One of the issues in the insurance climate change sphere is the role of insurers in insuring entities that are large greenhouse gas emitters, including but not limited to fossil fuel companies and utilities using fossil fuels. Have state insurance regulators discussed imposing charges or underwriting mandates on insurers that write or insure large greenhouse gas emitters?
Dennis, there has been some discussion on this important but controversial topic, this subject. Mandates and so forth. Some would call that the stick approach to regulation. It's not one that I favor at all. We should take a more collaborative approach and identify opportunities for insurers without requiring them to stop writing coverage for certain sectors. A large part of our population and economy are still reliant on these sectors for energy, so eliminating insurance coverage entirely could have a reverberating effect on consumers. Different states have different interests depending on their individual resources. Those interests are unique and should be protected. But we also need to acknowledge that there are companies that are changing their business models to shift to renewable energy. So to kind of pull the rug out from under them now would prohibit their ability to continue to adapt. So I think a better approach may be to encourage companies in these sectors to innovate and for insurers to drive the change by supporting their transition.
Well, thank you for that perspective. Our next presenter is Stephen Rothstein. Mr. Rothstein is the founding and managing director of the Ceres Accelerator for Sustainable Capital Markets. Ceres Accelerator aims to transform the practices and policies that govern capital markets in order to accelerate the reduction of the world's worst financial impacts of climate change and other sustainability threats. Steve has over 40 years of experience, and that experience will be critical to explore the most effective strategies for the accelerated to focus on and to move capital markets towards sustainability. Steve's been at this a long time. It's worth noting that after college, a wee time ago, Steve was one of the founding members of Citizens Energy Corporation, the world's only nonprofit oil company. That enterprise and its now many related organizations grew to provide service to millions of low-income and needy individuals. Steve's going to provide an investor, a climate investor focus on this important topic. Steve, the floor is yours.
Dennis, thank you. Thanks to you. Thanks to the Connecticut Department of Insurance and Commissioner Mays. And it's a pleasure to be in the same panel with all these distinguished guests. And Director Farmer, your comments and the leadership of NAIC is really moving this forward and is recognized. So I'm, as Dennis said, with Ceres. Ceres is a nonprofit, and we represent investors and companies on climate and sustainability issues. Our investors, just to give a context, they represent collectively around $35 trillion of assets under management, some of the largest, the BlackRock and State Street and others, as well as some of the smaller ones, helping them on their sustainability journey, been around since after the Exxon oil Valdez spill. First is, why is this important? And again, I don't tell anyone on this panel or anyone watching, but climate is a systemic risk and growing dramatically. We don't have to go further than literally go back a few weeks to Hurricane Ida, where right now I just read a report that the risk management solutions, they estimate that the cost from Ida could be between $31 and $44 billion. And at the same time as we were facing this risk on the eastern part in 19 states, the western part was facing droughts and fires. So we are facing these enormous, almost biblical challenges that are getting worse and worse. In addition to the transition risks, just last year alone, the oil companies had to write off $145 billion of costs because of transition in the economy. And that's dollars that companies, investors, bankers, insurers will affect them. So climate is not just an important issue from a climate perspective. It is also a critical issue from an insurance, from a safety and soundness perspective. And there are great examples of regulators. Director Farmer is one of them. There are great examples of companies that are doing work, but the problem is bigger, and we as society need to do more. So again, appreciate the Connecticut Department of Insurance is pulling us together for this discussion. That the insurance industry is such a bellwether for the rest of the economy. Dr. Farmer just talked about, whether there should be a carrot and a stick, and I think there's roles for both. But at a minimum, we believe that the real price should be built in, and that just based on recent history and loss ratios and premiums and things like that, it's probably not built in enough so that there's a marketplace. If you're going to do a fossil fuel project, is the real cost of not just the insurance, but the risk and the cleanup and everything else built in. There are literally tens of millions of homes that are not in the official floodplain, but are exposed. The fires and floods, with the droughts out west, that's affecting not just people's water, but it's also affecting energy. It's projected that in the next several months, there'll be a 14% reduction in hydropower, which affects energy use in many Western states. So the problems are challenging. Appreciate all the leadership from everybody on this call, but I think collectively our message at Ceres is that we need to do more. We need to look at climate stress tests. We're very involved with the banking industry, obviously the insurance, pensions, and investors. As we also look around the world, there is some great leadership that we can participate in and learn from. And I know NAIC is a member of the Sustainable Insurance Forum, but there are some of our European colleagues collectively that are moving a little faster on these things. So I appreciate this opportunity, Dennis, and turn it back to you.
Thanks, Steve. Director Farmer discussed some of the work of the insurance commissioners, including the Connecticut Insurance Commissioner, to increase the TCFD climate disclosures from insurance companies. We know Ceres supports that. What is the TCFD for our audience, and why is that effort important?
Sure. So first is great question. Thank you so much. And appreciate, as Director Farmer said, I mean, his leadership on these issues and making it a priority, and the 5 task force work groups that he's set up. So first is TCFD is the Task Force on Climate-Related Financial Disclosures. It's an international group. It was set up by the Financial Stability Board just 5-6 years ago. Why is it important? There is no problem that any company, whether it be insurance company or any company that insurance companies insure, you can't manage a problem if you can't measure a problem. It's the first step to any problem. Measurement is whether it be pandemic-related, currency issues, crypto, anything, including climate. So TCFD provides kind of an apples-to-apples comparison. It also now, because it's used by over 2,000 entities around the world, there's a lot of data, including a lot of insurance companies. So the six of the insurance commissioners, including Connecticut and others, started in 2009 to collect climate risk data, which was a great step, a really important step. As the science and the technologies move forward, we believe, and many others do now, that the TCFD, it will provide more level of data. So 2 years ago, the 6 insurance commissioners recommended, it was on a voluntary basis, that the insurance company use TCFD as a replacement for their submission. 2 years ago, 1 company did it. This past year, 8 companies. And we know the filings have just come in. I don't know the numbers, but I'm cautiously optimistic it'll be a lot more. So it's basically, it's an apples to apples now. It allows insurance companies or investors or regulators or advocates to know more what companies are doing so that we can address this. And insurance companies are uniquely positioned to both have a positive impact and to have risk on climate, both on the investment side and on the product side. On the investment side, they're large investors, and we did a series did a report in 2016. So the data I'm about to say is now several years old. But back then, insurance companies overall had a overweighting on their investment side on fossil fuel. So they had more investments as a percentage than the market overall did back in 2016. We don't think that makes sense now, and we don't know what the number is now if we want to update that. So the investment side is very important. And again, we work with investors all over the world. We now have a worldwide consortium of investors, collectively $43 trillion of assets under management, worldwide partners who have committed to be net zero. But insurance companies also have a critical role on the policy side. And there is a risk on the side, but there's also a big opportunity. With growing businesses in renewables and other areas, businesses in mitigation. So TCFD is a great basis for, we don't think it's all that's needed, but it's a great basis, and we appreciate what NAIC is doing. That those 6 insurance regulators have now grown to, I think it's either 15 or 17 states that have signed on. I apologize. And so that's great. And our hope is that NAIC encourages it or mandates it nationwide. There's also an active effort by the Securities and Exchange Commission to look at this. They're expected to issue draft rules end of this year, beginning of next year on this very issue. So it is a basis. Again, you can't manage a problem if you can't measure it, and TCFD is a great start to that. Dennis, back to you.
I appreciate your perspective, Steve. Thank you. Our next speaker represents an insurance underwriter. Hank Watkins is the president of the Americas for Lloyd's. Lloyd's is is an insurance market located in the UK. And Hank is responsible for the Lloyd's market development activities in the US and countries in the Western Hemisphere. Lloyd's is actively engaged in educational marketing outreach to a variety of agents and insurance and reinsurance intermediaries, and is active in risk management. Over the past 40 years, Hank has held a range of underwriting, client management, and leadership positions in the US and Europe. Hank, could you give us Lloyd's perspective and what it is that Lloyd's is doing in response to the change in climate?
Thank you, Dennis, very much for the introduction, and thank you, Commissioner Mays and the department for the invitation today to speak to the Connecticut Conference on Climate Change and Insurance. I'm honored to be representing Lloyd's on this panel of respected industry colleagues. Now, whether you believe that the current and future pandemics, cyber threats, geopolitical instability, climate change, or the prospect of a legal system that continues to deliver outsized monetary verdicts, social inflation as it's widely known in the U.S., is the key systemic threat facing us, there's no doubt that 2021 has been the year of climate. We've known for a long time that climate change is a systemic risk like no other, with the ability to dramatically alter the way we live our lives and plan for the future. Climate risk is something which affects all of us through physical risks, such as increased natural disasters, changes in global temperature, rising sea levels, and transition risk, which Stephen alluded to earlier, the transformation of the global economy to a more sustainable model. There's a deep level of change it represents for industries and communities throughout the world. And while 2017, a year that saw hurricanes Harvey, Irma, and Maria devastate large parts of the U.S. and Caribbean, wasn't that long ago, subsequent extreme weather events in Australia, Asia, Europe, and the U.S. have been more widespread in their impacts, much of it due to historic wildfires and levels of rainfall that cities and towns were unprepared for. As we build back from the pandemic, I'm likely joined by my panelists in the acknowledgement that most people now have an increased understanding of risk, especially systemic risks posed by our changing climate, and are more tuned into the conversation around the conference theme we have today than ever before. With our industry's unique perspective on the climate crisis, developed over many decades of providing support to communities, businesses, and economies in the face of increasingly severe and frequent weather events, we have a critical role to play in mitigating and managing the impact of these disasters. From this perspective, we can also see where systemic risk hurts the most. In many countries, COVID-19 and climate change have adversely affected certain demographic groups. The more vulnerable and disadvantaged a population is, the more likely it is to suffer from extreme weather events due to low awareness, a lack of access to risk transfer solutions, and poor financial health. The climate protection gap alone is deeply concerning. Several studies have shown that in 2019, natural catastrophe events resulted in economic losses globally of more than $230 billion, yet only $71 billion were insured. What's more, an increase in volatility and severity of weather events means that insurance may become more expensive as we look to achieve the correct price for the risks we assume. It may also mean that those who can't afford insurance will continue to go without it and in the end fall further behind and leave a private lender and/or governments to assume greater financial risk. But we can't solve for climate change through the pricing environment. We're facing a complex problem requiring a multifaceted approach. As experts in modeling risks and with years of loss data available within our organizations, we have the talent, knowledge, and ability to mitigate these risks through research and proactive action. The impacts of our changing climate have highlighted the importance of industry's approach to ESG, and with respect to the E, reversing the tide against climate change has never been more important. In December of last year, Lloyd's published our first ESG report, setting out steps our market should take towards net zero carbon emissions by 2050. As the world's largest insurance marketplace, we're proud to be supporting our members, currently about 90 syndicates, on this journey. Our report sets out how we plan to align the Corporation of Lloyd's, who I work for, and the market we serve, with the United Nations Sustainable Development Goals and the Paris Agreement. Our aim is to integrate sustainability into each and every one of our business activities, from the risks we underwrite to the investments we make. Our ESG report is available at lloyds.com and sets out guidance to the market with respect to companies engaged in Arctic drilling, Canadian oil sands development, and the mining and use of thermal coal. We're strongly encouraging, not mandating, the market to cease writing new business as of January 1, 2022, and to non-renew existing coverage by 2030. Now, this is a challenge, of course, the industry faces. We've already discussed that a bit this morning in the conference, whether you mandate or encourage people to change their practices and support more sustainable efforts towards developing energy assets and delivering them across the world. It's a conversation that some people think we're moving too slowly on. Others don't want us to engage in it at all. We think at Lloyd's we found the right balance, and we're working very hard now to make sure we accomplish this. It's important to all of our stakeholders around the world that they understand that Lloyd's and increasing numbers of insurance industry players around the world are here to support them as we confront these issues, and we can build back from the pandemic stronger with them. Our recently published Climate Action Roadmap sets out in a very practical way how the insurance industry can partner with critical industries, energy and transportation among them, to support the change more and more people now acknowledge is inevitable. And to facilitate the transition, our industry must understand and respond to what customers and other stakeholders expect from us with respect to ESG. We believe wholeheartedly that our customers want us to be greener, more transparent, and a force for good. And there's room for insurers to do more here, again, as my panel colleagues have alluded to, and it's our responsibility to show how we're progressing on the path to net zero. As an example of this, just in June of this year, Lloyd's was invited by His Royal Highness, the Prince of Wales, Prince Charles, to chair a task force focused on helping the insurance industry facilitate the global transition to a net zero carbon economy. One of the stated aims of the task force is to develop insurance products that can support the world's progress toward a resilient net zero economy. The task force, which is part of Prince Charles' broader Sustainable Markets Initiative, includes a global coalition of many of the world's largest insurance firms and organizations. Among them are AIG, Allianz, Amwins, Aon, Ascot, AXA, Beasley, Conduit Re, Direct Line Group, Hiscox, Howden Group, Legal & General, Lloyd's, Marsh McLennan, Munich Re, Phoenix, Tokyo Marine Kiln, Aon Risk Solutions, and the Insurance Development Forum. The SMI Insurance Task Force has published its statement of intent, committing it to providing climate-positive financing and risk management solutions to support and encourage individuals and businesses around the world to accelerate the transition to a more sustainable future. This task force is committed to helping create this more sustainable future through the risks we manage and the capital we invest. Now, for commercial and individual customers, this includes adapting and expanding coverage for offshore wind projects in response to rapid growth and new technologies, alongside the implementation of Build Back Better claims clauses and home insurance policies to encourage customers to rebuild sustainably. The SMI Insurance Task Force will also work with governments and regulators to establish a public-private disaster resilience, response, and recovery framework, which will help protect developing nations from the evolving economic and societal impacts of climate change. Now, as we all begin to recover from this pandemic, which has caused significant and far-reaching financial and societal challenges, we do so with an opportunity to build back with sustainability as a foundation and a guiding principle. The pandemic has raised awareness across the world of the impact a lack of awareness and preparedness can have. We can choose to be aware and prepared for the systemic risks to come, and there's no industry like the insurance industry to facilitate that change. The key challenges insurers will face, of course, is the need to find the balance between providing cover that reflects the risk profiles of our customers and the availability of historic data to support that at a premium that's not prohibitively expensive for the industry sectors we're discussing today. And I'll close with just a personal anecdote. Growing up in Southern California, I experienced the late summer wildfires each year. At the time, they were much less frequent and had fewer long-term consequences to communities because the population was a lot smaller back then. And other than keeping us inside during recess, the impact was largely confined to the foothills and the mountainous areas to the east. We got used to them, as we did to periodic earthquakes and the blankets of smog generated by the leaded fuel that ran Southern California's car culture of the 60s and 70s. Fortunately, state and federal governments intervened, passed the Clean Air Act in 1970, and by the mid-1990s, leaded fuel had begun phasing out across the U.S. At the time, this was an encouraging example of legislators and regulators working together toward a universally agreed goal of improving the environment. The climate change conversation wasn't on the table back then, but given past success at mitigating a clear and present danger, one has to be encouraged that precedent like that can be followed as we tackle the significantly larger climate-related challenges we're all living with today. Thank you, Dennis. Back to you.
Thank you. It was interesting to hear the convergence between some in the insurance industry and Steve's organization's goal regarding the need to move towards a net zero carbon emission scenario. Can you expound further on the Lloyd's Climate Action Roadmap and what steps it suggests are needed to facilitate a transition to a net zero carbon emissions?
Yes, and again, this was published back in July as a follow-up to our ESG report in December, which was very broad. It covered environmental, social, and governance elements across the world as we saw them. The Climate Action Roadmap focuses strictly on the E element of that. And it's really a way that we at Lloyd's are trying to lead the development of new solutions for risk transfer that enable green innovation, whether it's for hydrogen production and utilization or for the increasingly challenging risks associated with very deep water wind farm development. There's a lot of that going on, fortunately, and our industry is very well prepared to lead that infrastructure insurance opportunity. I also mentioned in my remarks that there's an opportunity for public and private getting together to develop disaster resilience, response, recovery frameworks to better protect not just our own nations in the West, but global economies and developing nations around the world. And I think, Stephen alluded to the $35 trillion under management, but you look at the global insurance industry, that there's more than $30 trillion in assets under management that we collectively can allocate towards direct investments in industries that are supporting the transition to net zero. Lloyd's alone is looking very closely at allocating part of our investment in the central fund, which is our backstop should a syndicate go sideways for some reason. It's set up there to pay the claims of customers who are affected. We have about a $4 billion central fund, and we have control over the investment of that fund at the Corporation of Lloyd's. Initially, in the next year, we're looking at allocating about 5% of investments in green technologies, and then from there, I only suspect it's going to go higher. So there's a lot that can be done there. All this is outlined in this Climate Action Roadmap. Again, you can find that on Lloyds.com.
Great, thank you. Our final presenter today provides a broader perspective across a variety of insurers and other financial services entities. Greg Lowe is a director in Deloitte's Sustainable Finance team. He brings over 10 years of sustainability experience in financial services with a particular focus on insurance, strategy, data, analytics, and climate resilience. Greg was managing committee chair of ClimateWise and was on the board of the UN Principles for Sustainable Insurance. So he's been on both the inside and the outside. Prior to joining Deloitte, he was the global head of resilience and sustainability at Aon, having started his career in investment banking. Greg holds an MSc from the London School of Economics. Greg, can you share your perspective?
Thank you very much, Dennis, and a huge thank you to the Connecticut Department of Insurance for inviting me to this distinguished panel. I join you today from London and here to give you a little bit of a perspective on what we're seeing across the global insurance markets, but particularly here in the UK and across Europe. And I bring that to you with an American accent, of course. So I think if I look at the challenge that the insurance industry is facing in this space, we're really focused on helping our insurance clients with really three key pieces. Risk, governance, and regulation. So that's sort of the first stepping stone I think many insurers are looking at when they're thinking about climate change and wider ESG risks. The second would be around strategy and its integration across business operations. And then the final piece is really more on that innovation, product development side, thinking very much towards the future. And I work with insurers from all parts of the industry, so life insurers, reinsurers, property and casualty insurers, consumer-facing P&C insurers, as well as the specialty market here in London within the Lloyd's market. And we see everyone's at a very different stage in their journey, but I do think that journey is very much headed in the same direction. So while you have a few leaders, I think what you have right now in the industry is sort of a crowd trying to get through the doorway on the progress to a more resilient and sustainable industry focused on addressing the challenge of climate change. If I kind of think about a few different themes we're seeing in the market, I'd summarize them as the following. Regulations have been spoken about a bit. I think the UK has certainly been a little bit ahead of the curve there, but I think the message around regulation is it's very much an advancing pathway, and there's also a lot of feedback loops there as well. So if I take the UK example, we first had the PRA of the Bank of England, the Prudential Regulatory Authority, make some noise around the topic of climate change in the insurance industry almost 6 years ago now. That manifested itself in a supervisory statement that was announced in April 2019, Supervisory Statement 319, that really was asking for the insurance industry and the wider financial sector to address how it was effectively managing climate change risk. If you fast forward to where we are today, there's a deadline for all insurers in the UK, as well as banks, to actually explain to the PRA how they're managing this risk. Now, that doesn't mean that they have to be leaders, necessarily, but they have to effectively describe how the risk is being managed and governed within their organizations. You then had a few months later, in the autumn of 2019, the General Insurance Stress Test, which had a climate change dimension to it for the first time. And the PRA used this General Insurance Stress Test, which was just, for a couple of the top insurers around climate change, as a means of looking at what they were getting back and seeing what needed to be refined. That was followed by a letter that came out by the PRA last summer, called the Dear CEO letter, where essentially the kind of response from the industry that they saw was insufficient. And then this year you've had something called the biennial exploratory scenario. So something we call the climate biennial exploratory scenario, the CBES, which is the first climate stress test for the financial sector. So that's covering some of the largest insurers in the marketplace, both on the life and general insurance side. It covers the Lloyd's market. So Lloyd's have nominated 10 different syndicates to participate in that, and it includes banks and asset managers as well. At Deloitte, we're currently supporting a couple clients in that space, and that's been a very, again, interesting journey, essentially kind of peeling the layers of the onion back to see what the exposure of the industry to various aspects of climate risk happens to be, both on the underwriting and the investment side of the balance sheet. And I think what the PRA is doing with this is they're going to look at the results, see what needs further refinement, where do they see potential risks. There's interestingly a piece on the CBES that looks at banking and insurance interactions. So there's a very holistic perspective. And I think we're seeing the same approach from the European Commission as well. We know that the Singaporean and Japanese regulators are moving in a broadly similar direction, Bank of Canada as well. And we've heard from Commissioner Farmer very much around what's happening with the NAIC. So I do think that there is a broadly similar direction of travel. And I think for everyone listening in the US, I think kind of paying attention to what's happening here in the UK, is a nice sort of maybe preview into where things eventually sort of get around the world in perhaps 5 to 10 years' time. If I think about another big thing we're seeing right now, as a result of regulatory questions, but also some of the investor perspectives that Steve was sharing earlier, is I think a growing focus on quantitative approaches. Now we know that the insurance industry has been a leader in modeling and analytics for a very long time. I think this is getting quite deep then when you start to look at how underwriting portfolios perform around transition risk. So I think while the physical risk side of this on the underwriting side of the balance sheet is in reasonably good shape, really thinking about how different shocks to the economy due to transition risk, that's definitely kind of maturing. And you could almost say the opposite on the investment side of the balance sheet. I think a lot of the transition risk focus in the capital markets has primarily been in the asset management world, perhaps a bit of a less understanding on physical risk, but there is a need to understand both. And that sort of maybe brings me to a point around net zero strategies. So we have seen a proliferation of insurers in Europe start to announce net zero commitments. these often start with just net zero commitments around the operations of insurers. But for instance, we saw Aviva announce in March this year that they were going to become a net zero insurer. So that meant across operations by 2030 and across the investment and underwriting side of the balance sheet by 2040. And there have been other similar announcements since. You saw the formation of the Net Zero Insurance Alliance this summer by the UN, and that's sort of a group of leading insurers. So you have Swiss Re, Munich Re, SCOR, Zurich, Allianz, AXA, Aviva involved, Generali involved in the Net Zero Insurance Alliance, trying to think about how do you actually define net zero underwriting. And again, there's lots of commitments coming out from the industry. I think the sort of plans around how do you execute on those commitments and sort of not risk greenwashing, that is a big question for the industry right now. And perhaps we kind of get into some of the challenges around the topic of what insurers should or shouldn't insure when it comes to different industry types. Maybe the sort of fourth would be around collaboration. I think we're starting to see across the insurance value chain. So if you kind of think about the role of the broker, the role of the underwriter, the role of institutions like Lloyd's or reinsurers, ILS funds, all play a role. I think there is a recognition of greater collaboration there. This is a theme that we highlighted in a white paper we wrote for ClimateWise on the topic of the journey to net zero and really kind of focusing on product innovation across the industry. And I think one of the messages there was very much on you can't sort of solve this at a single company level. It has to involve all parts of the insurance value chain. And you've seen this reflected with things like Willis Towers Watson's climate transition pathway approach, which is trying to create sort of a dialogue between some of the clients that they're placing business for in the market with leading underwriters. And then maybe the final piece is this actually intersection between the E and the S of ESG. And I think that sort of manifests itself on the one hand around the topic of a just transition. So how do you ensure that those impacted by the transition in industry are not left behind? But I think kind of to the point of the protection gap that Hank was discussing earlier, I think there's a real issue around financial inclusion. And one of the results of CBES we've seen is, I think insurers are often talking about this as a pricing challenge, but I think what makes sense on an individual company balance sheet perspective, if you kind of magnify that across an entire market, do we actually see people left without access to affordable insurance? So that recognition of where climate strategy actually has impacts on wider societal objectives is I think something that's starting to get more traction. And interestingly, I'd say the just transition question is perhaps quite relevant in the life insurance space, where the whole concept of income protection is seen as an opportunity for product innovation there. So I might just leave everyone with those sort of observations across the market. And back to you, Dennis.
Well, thank you, Steve. Greg. Sorry about that. You touched upon it somewhat, but I was wondering if you could provide some more detail upon what you're seeing as companies try to incorporate ESG and climate considerations into their underwriting process, and to the extent there's a difference between how the Europeans versus the U.S. companies are incorporating it. Would be interesting, I think, for our audience.
Yeah, I think it's a great question. So the topic of integration of ESG into underwriting had sort of been floating about in the ether for a little while, but I think it got quite a bit more attention with the release of a UN PSI paper that Allianz worked on with the PSI. And I think that was about a year and a half ago, around sort of this topic of, how do you integrate ESG considerations into underwriting? And actually, I think, that's been sort of the leading reference for the insurance markets, which sort of really classify relative risk rating levels for both lines of business as well as economic sectors. And, I think at the end of the day, the individual risk appetite is going to be up to the insurers. But I think one thing we see some insurers starting to recognize is that as the economy transitions, and I think you have to reflect upon the fact that we've had about 72% of global GDP make some kind of net zero commitment of one shape or another, most of which by 2050, although China 2060. So I think there's a recognition that unless you're sort of taking this into account when you're underwriting business, you're potentially sort of not managing your portfolio appropriately. I think the approach in Europe has been a little bit more quantitative, perhaps. I don't want to say binary, but that we've seen certainly more of the discussions around what is or is not going to be kind of insured by economic sector and line of business, perhaps a little bit more of a vibrant discussion, and that's because you actually have something in development in the EU called the taxonomy, which essentially defines what's a sustainable or green activity and what may not be, and so there's a recognition of the direction of travel there. I'd say with U.S. insurers, you primarily see this maybe more around U.S. insurers that have big exposure to the Lloyd's market, who I think are approaching this more from a how do we actually have conversations with our clients around getting them to move to a viable transition path, maybe asking for sort of transition plans. So I think it's perhaps a little bit more of a slightly more of a collaborative approach, although I'd say that, while most European insurers are talking about this, I'd say fewer US-based insurers are.
Well, thank you. I think we've got a little more time, so we're going to move into what I'm going to call our lightning round of questions, encouraging you all to be pithy as we get to it. Director Farmer, I'm going to start with you. We've heard about the activity internationally, federally, and at the states, is insurers are looking to respond to climate, but also trying to efficiently handle their traditional business, which is providing effective loss coverage and risk transfer opportunities to consumers at a price that makes sense to consumers. Are you seeing any sort of convergence or consistency in the approach between the various entities that you deal with beyond the NAIC, which you told us you were seeking to achieve a consistent approach?
Yeah, to a large degree, Dennis. The NAIC is extremely active at the International Association of Insurance Supervisors and the Sustainable Insurance Forum, but it kind of goes back to some of the issues that Steve Rosting talked about on disclosure and trying to make sure everything is addressed and uniformly. So I think from that aspect, we're seeing a little bit of that, but there's plenty of room for improvement in all of that.
Thanks. Steve, briefly, what do you at Ceres hope that insurers do in the climate realm? What are you seeking from them?
Thank you, Dennis. And it's following up on the comments both from Director Farmer and Hank and Greg. First is to understand themselves what their exposure is, then to have a long-term plan, so a net zero by 2050 plan, then as was said, and some of our colleagues have done great work in this area, a science-based plan in the short term. So it's, okay, between now and 2030, here's where we are for each line of business. We have to reduce our emissions, and here's our steps, send clear signals to reduce the exposure while looking at the new opportunities from green energy. This is a big risk, but it's also an opportunity. And no company, whether it's does well with the ostrich approach, kind of waiting for the problem to get on them. So, this is not a future problem, but it's a today problem. So having a long-term plan and then a short-term science-based with annual measurable goals that they, the directors, their investors and regulators can evaluate.
Thanks. Turning to you, Hank. As Steve just said, climate change is a challenge and an opportunity. From Lloyd's perspective, why is insurance so critical as we transition to a net zero economy?
Well, yeah, it's we. As we all mentioned in our remarks, our industry has significant experience over decades, lots of data. We have more data available to us than many other industries. We just have the challenge, of course, deploying that appropriately. Modeling is one way to do that. But of course, as the disparities between what we used to see as natural catastrophe outcomes and what we're now seeing continue to grow, there's a big challenge for the industry to keep up with that. We do have, of course, as I mentioned earlier, that $30 trillion in combined capital. That's a capital pool that the industry can control to do more, to encourage entrepreneurialism, innovation, to simplify products. We've seen, for example, the need for policy wordings post-pandemic, especially around business interruption, to be much clearer to anybody who buys policy from our industry. Commissioner Farmer mentioned parametrics, and that was very encouraging to hear that, because that is increasingly, although not a new concept, it's increasingly acceptable around the world as a means of attaching capital immediately to a risk need after a major event. It's a way to bring coverage availability to people who normally might not have had the access to it through technology as simple as a smartphone. So there's a lot of encouragement, a lot of help that we can provide as an industry to risk managers via the support of regulators, of course, and all the other industry service providers that we work very closely with. I know that Greg in London there and Lloyd's have a very strong relationship. Lloyd's was one of the original founders of ClimateWise many years ago, so it's encouraging to see that having developed to where we all are today, having this conversation across most elements of our industry.
Well, thanks. And Greg, we're going to let you, as the broad perspective advisor, give us some advice on how we transition to a greener energy future. As we transition, we need to start. The road of 1,000 miles begins with a single step, so we need to start. But as we do that, there's a need to keep using fossil fuels for a yet to be determined period of time in the future. How do you see the role of insurers in helping to ensure a needed continuous supply of energy resources during this transition period?
Yeah, it's a great question, Dennis. And I think Steve kind of hinted at this when he talked about the Science-Based Targets Initiative. So I mentioned that a few insurers are making net zero commitments, but I think what the Science-Based Targets Initiative actually outlines is this isn't sort of an immediate, 100 to 0 journey in 2 or 3 years. It is a series of steps. I think the role of the industry here is to have those dialogues, to understand where its insureds are on this journey, just to even understand what is their decarbonization pathway, and have I think a frank conversation around its own perspective on some of the physical risk challenges that are sort of a result of the sort of current rate of emissions. But to kind of understand where that journey is taking them, and I think more importantly also to ask what types of insurance solutions would be helpful to you to accelerate your transition plans. And a lot of time that's focused on things like renewable energy, et cetera. But I think even things like decommissioning fossil fuel assets that are being retired, a very big topic in the market right now.
Well, thank you. I thank all of our panelists for discussing the various perspectives, as well as letting us all see the challenges and opportunities ahead of us. We've got a work cut out for us collectively, and collectively we can achieve great things. I'd also like to thank you, the audience, for your interest in this important topic, and for Commissioner Mays for convening us all. We will continue to work with Commissioner Mays and the Connecticut Insurance Department on these important issues. And we look forward to more opportunities to discuss where we are and how much progress we're making. Again, thank you all.
Thanks, and it is great to join you by video today on an important topic that impacts all of our lives: climate. Decisions we make today will shape how climate impacts the buildings we live and work in for years to come. The insurance industry recognizes this and came together earlier this year to outline the actionable steps we can take now at the federal and state level to improve resilience. Enacting wise climate adaptation policies today will make for future thriving communities. The property insurance industry outlined 6 principles that frame the issue and our needed actions. These are the companies leaning in, leaning forward to adaptation. There are tangible things we can do to reduce the impacts of these weather and climate disasters on home and business owners alike. So I'd like to walk you through these 6. At the very foundation, climate change adaptation is necessary. As the frequency and severity of natural hazards changes, our buildings need to be prepared. More and more, this is a settled fact that needs to be clearly and regularly articulated. While we look at future decades, there's so much work needed to address today's buildings, today's communities, today's risk. And this work on today's risk will serve as a roadmap for pulling down the long-term risk. We need to apply the engineering we know before disasters strike. One of the broad ways to apply that engineering knowledge is through building codes. You know, the latest building codes save $11 for every $1 invested. Yet our building codes and land use really need to consider tomorrow. How, when, and where development occurs impacts the community's resilience. Yet we must recognize, honestly, that many of our homes, they're already built. As instrumental as best-in-class building codes can be, they don't change anything on a home or building that was constructed 10, 15, or 40 years ago. We need to prioritize funding to increase the resilience on that already built environment. There are reasonable retrofits. Every time a roof is replaced, whether that's due to age or damage, it is an opportunity to increase the resilience of that structure. When the next Ida barrels through with high winds and torrential rains, the water doesn't need to intrude into the structure. We don't need wet drywall and carpets. We know how to do better. Next, resilience is a necessity, not a luxury. Again, it's not a luxury. We need to make resilience accessible to all homeowners. Affordable housing should be resilient, full stop. We can't keep viewing resilience as an option only for the rich. The families that live in multifamily units or affordable housing endeavors are usually least able to afford the cost of damage, disruption, and displacement. We need to help these communities be resilient. We must use the data and expertise across the public and private sectors to inform climate adaptation decisions. You know, these decisions happen locally, and there should be pathways for the knowledge to reach those local decision makers. And lastly, we need to put greater priority on the resilience of community infrastructure. When government dollars are invested, there needs to be a reasonable expectation that the first dollar will be the last. The taxpayers will not be paying for the same project twice. When building science informs decisions, the science and engineering can really have a real-world impact. We can narrow the path of damage. Many of these solutions, they're known, yet they remain distant to too many until after the disaster strikes. We need to be proactive ahead of the storm to instill this resilience. So I want to come back to the roof. It's one of the simplest ways to improve a home's resilience. Every home has a roof, and every home needs to replace that roof, at least at some point. Normal wear and tear drives asphalt roofing replacements every 10 to 12 years. And then there's the effects our roofs are put through storm after storm. Think Elsa, Henri, and Ida. Enduring the intensity and duration of the wind and rain, it suffers building fatigue. Those shingles bend and then they tear off. And water drips through the seams of the roof deck. And soon, the couch is ruined. We know this scenario only becomes more likely as the climate changes. We have the engineering solution, a sealed roof deck. It adds a few $100s to the cost of re-roofing a typical home, yet after a storm, the difference is dramatic. A few $100s to come back and sit comfortably on the couch, to keep families in their home and to maintain the fabric communities. We just need to do it. To make the investment in the resilience of our communities. It works. This sealed roof deck is key to the fortified roof program. Nail it down. Seal it up and lock it in. 3 steps to keep the wind and water out of a home and keep the family in it. These are the choices we need to encourage to help homeowners adapt to climate. We've watched it benefit other states. You know, after Ivan hit the Alabama coast in 2004, they embraced fortified and the sealed roof deck. Last year, Hurricane Sally demonstrated how valuable that commitment was. 17,000 families were protected. 17,000 homes better prepared for the storm. 17,000 roof decks holding strong against the wind and the rain. The decisions we make today, they can better prepare our communities for the weather they'll face tomorrow. These decisions we make today are fateful. Whether our lives will be disrupted, our families displaced, and the costly repairs required, all these potential effects can be shaped. They can be shaped if we choose to make the informed choices and adapt to our client. You know, these elements are front and center for you in Connecticut. You've led the way in so many dimensions. And now that leadership needs to continue to push through, continue to be on the front side of our conversations about climate, about how we address affordable housing, how we address the needs in our building codes, to not slide back, to not regress, but know that we don't get to choose the time. Yeah, it might be a nor'easter, but it might be an Ida that picked up from the Gulf Coast and then accelerated through New England. These really are your opportunities. And so I appreciate that this group chose to focus on climate today. But I want to make sure that we don't simply admire this problem. I want to make sure that we keep leaning in and not just choose cheap words, but to make sure that collectively, as the insurance industry collaborates with the regulators and other policymakers, I want to make sure that we take all of these pieces together and choose well. Because those informed choices to adapt to our climate, they make a difference. They make a difference so that families, after the storm comes through, get to go home. That is what matters most. Thanks.
Hello, I'm Lieutenant Governor Susan Weissowitz. Thank you for joining the Connecticut Conference on Climate Change and Insurance. It is incredibly important that we have conversations like these discussing climate change in the insurance industry. The science is very clear. Climate change is real, and our administration has been working diligently to address the rising seas, frequent flooding, heat waves, and drought that we have already begun to see in our state. We've also proposed efforts to reduce greenhouse gas emissions from motor vehicles while reinvesting funds into programs that will reduce greenhouse gas emissions and air pollution. Our air quality is one of the greatest environmental threats to human health. Although air quality is improving in Connecticut, there are still many occasions each year when pollutant levels, measured according to the US EPA's Air Quality Index, endanger the public health, especially in vulnerable communities. We know that air pollution is associated with premature death, cancer, lung diseases, and cardiovascular disease. In Connecticut, we are working hard to address these issues every day. And the governor and I greatly appreciate our Insurance Department Commissioner, Andrew Mays, for putting together this conference with insurance professionals to discuss how climate change affects our communities, regulatory efforts, and businesses. Thank you again for your participation in this important event.